Hello there. Now that we have a little bit of understanding of what the Forex market actually is, I think it's time to dig a little bit deeper into new ideas and, new concepts. So let's get going. Well, first of all, let's get started with the Forex market opening times. As you probably know, the Forex is a 24/7 market. Actually 24/5 market, since it's not open on the weekends, of course. That's pretty different from the stock markets. Probably know Wall Street is open from 9:30 a.m. to 4 p.m. Eastern Standard Time. That's the period of time where transactions go through, where you can go to the market and place your buy or your sell orders. In the Forex market, you can place your orders all around the clock throughout the day. And that's because the Forex market is actually a global market. Okay, it's not centralized in any particular part of the world. Like I said, it's a global market, and therefore it's always open, because as one particular market, let's say Wall Street, closes down, there is another market somewhere else in the world that's opening at that precise time. So transactions are allowed to keep on going through, even if it's 3 a.m. in the morning, your time, no matter where in the world you live, okay? Here's how it works. Let's imagine you are located in the United States, all right? And let's not forget Alaska and, well, Hawaii, of course. Anyway, let's imagine you are located in the United States. For you, in American time, the Forex market will open on Sunday afternoon. And, here's why. On Sunday afternoon, your time, American time, it's already Monday morning in Australia. The Sydney market, which is somewhere around there, will be opening up, and therefore traders from all over the world may begin placing their trades. Like I said before, the Forex market is not centralized anywhere. Okay, in one, let's say, in one particular location, in one particular building, in one particular physical location. It's a global market. So as long as there is one market open anywhere in the world, you can begin placing your trades. I think the next market to open is the Tokyo market, which is 1 hour later, 1 hour behind. I believe there is 1 hour difference between Sydney and Tokyo. The next one to open is the Chinese market, the Hong Kong market, somewhere in there. And the day keeps on going through. The next major market will be the Frankfurt Open there in Central Europe. 1 hour later, the London market will open as well. And finally, believe it or not, the last market to open is the New York market. Right there, we've gone through an entire day, okay? And now all the markets have opened. Of course, by the time the New York market opens, the Sydney market has already closed. Probably the Tokyo one as well. At the time, actually, by the time the New York market opens up at 9:30 a.m. Eastern Standard Time, the only markets that remain open is New York, London, and Frankfurt. In fact, by the time New York opens, Frankfurt is closing. So at that time, only New York and London will be open. So to sum it up, to wrap it up, if you are located in the United States, the Forex market will open on Sunday afternoon, your time, because at that time it's already Monday morning in Australia. The market opens, and the world's Forex market kicks off for the week. Obviously keep on running Monday, Tuesday, Wednesday, Thursday, until Friday. Let me see if I can actually draw that with my mouse. Friday afternoon until 4 p.m. to be exact, when the Wall Street market, the New York market, closes down for the week. Remember that New York is the last market to open and close throughout the day, okay? Sunday afternoon, you may begin trading Forex. Friday afternoon, you, need to close the shop for the week. Okay, now that that's out of the way, it's time to get going with some important Forex definitions. So if you have a notepad around, just please grab a piece of paper and a pen, because you may want to take some notes here. Alright, the first thing we are going to be seeing is the bid price, the ask price, and the spread. Those are three very basic definitions when it comes to Forex. First of all, I'm going to give you the textbook definition, and then I'm just going to try to chew that up for you, so, I can drive the point home right away. Alright? Okay, the bid price. The bid price is the price at which the market, okay, not you, the market is prepared to buy a specific currency. A specific currency pair, that means. Again, the bid price is the price at which the market is prepared to buy a specific currency pair at any given time, of course. The ask price is the opposite, is the price at which the market is prepared to sell any specific currency at any given time, and the spread is just the difference between the bid price and the ask price. Now, I know that may sound a little bit confusing. Don't you worry, we are gonna turn that, we're gonna twist that upside down. So, like I said before, we can drive the point home right away. Now, for example, the euro against the American dollar right now is trading at 127.40. Okay, that's the ongoing market price. But, quite frankly, you will never see any currency pair expressed in one single price quote. You will always see two different prices. All right, you will see the bid price and the ask price. This is most likely what you are gonna see. You're gonna see the euro USD expressed in terms of two different prices. The first one is the bid, okay? This is the bid. The second one is always the ask. Alright? This is the bid and this is the ask. Now, why do we have two prices? Remember that we said that the bid is the price at which the market is prepared to buy at. Okay, this is what the market is prepared to buy euro against the American dollar at. This is what the market is prepared to sell the euro against the American dollar at. I'm sure you've seen this before. Every time you travel abroad, you go to the airport, you will see the typical currency exchange booths where you can turn your dollars or whatever your local currency is into any other currency, and you always see two prices. One is the price they will pay you for your dollars, and the other one is the price at which they will sell you dollars for your local currency. So like I said, I'm sure you've pretty much seen this double quote price. Obviously in those exchange booths at the airport, the difference will be between the bid and the ask is usually much larger. If the bid is 127, the ask should be at least 135, something like that, because these guys make huge profit out of the transaction in itself. In the Forex market, the point is to make money not out of the actual transaction but out of the price movement. Okay, so that's why the spread, the difference between the bid and the ask is very small. Those guys, they don't make a profit out of their goal is not to make profit out of the price movement, is to make money out of the commission, the transaction commission they charge their customers, meaning you and me and any other traveler. So but anyway, as far as the Forex goes, if you go to the market and you want to buy euro against the American dollar, the price you'll have to pay is the ask. Okay, since remember the definition is the price at which the market is prepared to sell the euro against the American dollar at. So if you want to buy, the market is prepared to sell you at this price. If you want to buy if you want to sell the euro against the American dollar, you will be given the bid price, since remember the bid price is the price at which the market is prepared to buy. So the easier way to explain this is just always remembering that you are gonna get the worst part of the deal. It's just the way it is. If you want to buy euros against the American dollar and you have two prices, one is cheaper, the other one is more expensive. If you want to buy, you'll have to pay the expensive one. If you want to sell, you will get the cheaper quote. Okay, it's just the way it is. There's always a transaction cost in every Forex transaction, and fortunately you are the one who's got to pay every time you place an order. You've got to pay that small commission, which is again the spread, the difference between the bid and the ask. That's your transaction cost. You'll always get the worst part of the deal, because for every transaction there is a little commission, and well, you know, that's part of doing business. Okay, now let's get moving. Let's talk about pips. Pip is the smallest price change that any given exchange rate can make. Most of the currency pairs are priced to 4 decimals, so the smallest change is that last decimal point. All right, so for example, if we are looking into the euro against the American dollar, and the current market price is 127.40, it doesn't matter whether you pick the bid or the ask. A pip is exactly the same for either. So for the euro against the American dollar, a pip would be 0.0001 euros. Okay, since the base currency is the euros, the smallest price change, the euro, if compared to the American dollar, would be 0.0001 euro. Okay, that's a pip for the euro against the American dollar. Now, not every single currency pair carries the same pip value. For example, the American dollar, the USD, against the Japanese yen, is only priced to two decimals. Okay, so let me see what's current market price. It's 91.21. That's the current market price for the USD against the Japanese yen. The smallest possible change, the USD in terms of the Japanese yen, could be 0.01 dollars. Okay, in this case dollars, because the base currency is the dollar. So the smallest change the American dollar can make in terms of the Japanese yen, which is the quote currency, is 0.01 dollar. 0.01 dollar. That doesn't mean that every time price changes, it changes in 1 pip or 1 pip at a time. Let me try to explain myself. If current market price for the euro USD is 127.40, that doesn't mean that the next potential or the next possible price change should be 127, either 127.49 or 127.39. It doesn't mean that price moves at 1 pip at a time. In fact, from 127.42 it can jump all the way up to 127.45. All right, so remember, just because a pip is the smallest possible change in price for any currency pair, in this case a euro, since we were talking about the euro against the USD, that doesn't mean that in fact every time the euro USD changes in price, it will do so by 1 pip. It can change all of a sudden by 3 pips, 4 pips, 5 pips, etc., etc. Okay, now in the Forex lingo, you will hear many times a very typical expression, which is I'm going long or I'm going short in this or that financial asset. Basically, going long or going short in the market is the same as buying or selling. Obviously, going long is buying, going short is selling. Now, as far as the Forex goes, once again, let's pick the Euro USD example at 127.40. If we go long in the Euro, it means we are buying the Euro in terms of the dollar. Okay, we expect the Euro to increase its value if compared to the American dollar. Basically, we expect the exchange rate to go up. Okay. In the other hand, obviously, if we are selling the euro against the American dollar, Basically, we are expecting the euro to depreciate its value if compared to the American dollar, and basically we are expecting the exchange rate to go down. Okay, that's very, very simple to understand. Always when you go long, when you buy a currency pair, you expect the base currency to appreciate its value if compared to the quote currency, and when you sell or when you go short on any currency pair, you expect the base currency to depreciate its value if compared to the quote currency. Okay, now expanding a little bit further into this long and short terminology, it's time to review what are probably the two more famous characters in the trading lingo. That's the bulls and the bears, which, like I said, is just Forex or trading lingo for buyers and sellers. The buyers are usually called in the trading circles the bulls, and the sellers are the bears. Okay. Again, don't let the trading terminology scare you off whenever you hear in the in the CNN, in the CNBC, or any of those news stations, stuff like in this recession market, the bears are in control and they are fighting off the bulls down to historical low levels. As I said before, don't let the trading lingo scare you off. That simply means that if we are going through a bearish market, and you look into any chart, you would probably see a downtrending price action. On the other hand, in any bullish market, you will simply see that there is more buying pressure than selling pressure, and therefore price should be going up, or we should be uptrending in that market. Okay. Again, don't let the Forex lingo scare you off. Bullish market just equals long positions, equals that there are more people willing to go long than more people willing to go short, and therefore price is going up. Conversely, in a bearish market, there are more people looking to go short than looking to go long. Therefore, the selling pressure is higher than the buying pressure, and therefore price is going down. That's about it. Okay, don't let the Forex terminology scare you off. Another definition you should be familiar with when it comes to Forex trading is a lot. And a lot, this is going to be very easy, so don't worry. A lot is the minimum amount, the minimum required amount that can be traded in the Forex market. Let's say it's the minimum amount you can buy from the market, or the minimum amount that you can sell to the market. The minimum standard amount is one lot when it comes to Forex, and that's 100,000 units of the base currency. So, again, if we pick the Euro USD as an example, one lot for the Euro USD will be 100,000 euros, because one lot, remember, is 100,000 units of the base currency. Base currency is always the first one, the first currency in a currency pair. The second one, remember, is what we call the quote currency. So, in the Euro USD, the minimum amount you can buy from the market is 100,000 euros. The minimum amount you can sell to the market, again, is 100,000 euros. This is what we call a standard lot. Now, some brokers allow mini lot trading. Mini lot trading is basically the same thing, but a mini lot is, instead of 100,000, is 10,000. Okay, that means that for all of you guys who are starting out, for all of those traders who may want to open up a small trading account to begin with, it's always a good idea to go with brokers who allow mini lot trading, just because that minimum required amount per transaction, it's certainly smaller. It's 10 times smaller than the market standard. So at the beginning, it might be a good idea to go for a mini lot trading accounts as opposed to a standard lot account. Now, obviously, if you're trading different currency crosses, for example, the USD against the American dollar against the Japanese yen, a lot will not be 100,000 euros anymore. It will be, in this case, 100,000 American dollars, since the base currency is American dollar. For example, if you're trading the Canadian dollar against the Swiss franc, one standard lot will be 100,000 Canadian dollars. Okay. Anyway, nowadays the brokers are not so strict, and like I say, most of them allow what we call partial lot trading, meaning that you can trade, for example, 1.2 lot, which in the case of the Euro USD would equal to 120,000 euros. Okay, so they are not so strict anymore, and that, it's a little bit more trading friendly when it comes to picking the right trading size on any particular transaction for you. Now, I know what you're probably thinking right now. You're probably thinking, Jesus, how could I possibly trade Forex if the minimum required amount is one lot, and one lot equals to, 100,000 euros, $100,000, or 100,000 Canadian dollars, etc., etc. And the answer to that is leverage. Leverage is the ability to access, to control a large amount of any security, any financial instrument, simply depositing a small amount of deposit of capital. Now, how much you can leverage yourself, how much you can leverage your money, depends on what broker you are trading through. The leverage requirements varies quite a lot from broker to broker. There are brokers who allow only 25 to 1, 50 to 1, 100 to 1 is it's pretty standard in this industry. Even 200 to 1 or 400 to 1. That's crazy leverage if you ask me. But 100 to 1 is very easy to find around. Now, if you open an account with a broker allowing 100 to 1 leverage, that means that with a $5,000 account, with a $5,000 deposit, you can control up to a $500,000 market power. That basically means that you can buy or sell currencies up to $500,000, or what's the same, 5 standard lots, which could sound fantastic and all cool and dandy, with a small account, $5,000, $2,000, $1,000, even less. You could start trading Forex. Could start buying and selling currency crosses in the Forex market, and yeah, that's positive. That's great. Leverage is a good thing, but it can potentially get very dangerous for your trading account, and the reason for that is margin and margin call. Let me try to explain what this means. Here's the thing. Here's the deal. Trading on margin can be potentially very profitable, because with a tiny amount of money you can have quite a high purchasing power in the market, which, as we said before, it's a good thing. However, it can also be potentially dangerous, because it can trigger a margin call on your account. Every broker monitors, all the trades that you take, how much you leverage yourself on every trade, and if they see that on any particular transaction it's turning around on you, and you are hitting a loss, and that loss may actually reach the point of, let's say, a point of no return, where the loss may be larger than the amount you deposited to begin with, they could automatically close out all your trades and, basically cash you out of of your account. They just close out your account, they grab your money, because they understand that the total of the losses you are scoring at that precise time on that precise transactions may be potentially larger than, like I said before, the amount of money you originally deposit. So be careful there. Be careful if you're trading through a small account. Again, $1,000, $2,000 account, $5,000 account, whatever it is. If it's a small account, try to avoid the the temptation of trading big, because I'm telling you, if you score one or two consecutive bad trades, highly leveraged trades, you are incurring a risk of triggering a margin call from your broker. In bear no doubt, they will close automatically all your trades. They will close out your account. They will grab your money, and that's the end of your account. So be careful. Leverage is a great thing. Without leverage, most of the individual traders could not access the forex market, because imagine if for every single transaction you had to deposit, the minimum amount you would need to deposit would be $100,000, which is one standard lot. So definitely leverage is a great thing, has opened up the forex market to us individual retail traders, but it's also a blade with two edges. Be careful there. Just try to keep your leverage under control, or otherwise sooner or later it will turn around and it will bite you. Okay, and the last basic definition we are going to be covering in this video is interest rollover. As you probably know, different countries yield different interest rates to their on their currencies, depending on their respective monetary policies. For example, right now, the time of recording this video, in America, the interest rates are only 0.25%. In other countries, England is offering a 1.50%, New Zealand 5%, Japan only 0.10%. It's been next to zero in Japan for years. Well, it's just the monetary policy the Bank of Japan, the Central Bank of Japan, is carrying out at the moment. And like I say, every different country yields on their respective currencies different interest rates. And what's important to us is not their monetary policies. We don't care about that. What we do care is about the differential, the gap on interest rates between two different currency of any particular currency cross we may be trading. For example, let's imagine we've gone long one lot on the New Zealand dollar against the Japanese yen. Basically, we could wrap up forex trading. If we had to sum up forex trading in one single sentence, that would be borrowing on one currency in order to buy another one. So if we went long one lot on the New Zealand dollar, Japanese yen, what we've done basically here is to borrow Japanese yen in order to invest that capital on the New Zealand dollar. That's basically what it is. We've asked for the loan, let's say, on the Japanese yen, and therefore we should be paying a 0.10% interest rate on that loan, and we are investing that money on New Zealand dollars. And as we can see here, at the time of recording this video, the interest rate for the New Zealand dollar is 5%. So in one hand, we are getting paid 5% for our money, and in the other hand, we are paying 0.10% of that same amount. So as you can see, there is quite a differential here, and that's what interest rollover come in play. The way forex trading brokers work is by offsetting that interest rate differential once per day. Most of the times, the industry standard is at 5 p.m. Eastern Standard Time. What they basically do is they see all the trades that you have open on your account, that you are keeping open overnight, and they calculate the interest rollover. They calculate the differential of the interest rates between those currencies that you are trading at that precise time, at that precise day, and they pay that differential on your account, or they extract from your account that very same interest rate differential. For example, as I was saying, if you are long on the New Zealand dollar, Japanese yen, in one hand you are getting paid at 5%, and in the other hand you should be paying 0.1%. So that's a positive plus 4.9% on that particular transaction. So what the broker is going to do is to calculate how much out of that well, 4.9 yearly interest should be credited to your account on a daily basis, on a 24-hour period basis, since, well, like I said before, they conduct this operation every 24 hours, every day at 5 p.m. Eastern Standard Time, and then credit your account as per one lot, which is 100,000 New Zealand dollars. Okay, that's basically what it is. Obviously, if instead of going long, you went short, you meaning that you borrowed New Zealand dollars in order to buy Japanese yen, you would need to pay that 4.9 yearly interest rate on a 24-hour basis. Okay, that's basically what it is. Now, to tell you the truth, practically speaking, quite frankly, interest rollovers hardly make any difference to us individual traders, small traders, if you will. And the reason for that is that, well, unless you're trading the New Zealand dollar, which is the highest paying currency of all, the highest interest rate currency of all, the most differential you are going to get is going to be around 1.5%. Differential, and this is on a yearly basis. Well, if we take in consideration that interest rollovers are calculated on a 24-hour period, that means that we should divide that 1.50% by 365 days. In I'm sure you understand that the total amount to be paid to your account, or paid from your account to the broker, is just so tiny that it hardly makes any impact at all on your trading account. So my recommendation is just don't you worry too much about interest rollover whenever taking a trade. Quite frankly, it's just so tiny that I personally don't care about it when I take a trade. Interest rollovers mostly is something for, let's say, large traders, such as, well, investment funds, institutional traders who trade millions and millions of dollars per position, and who keep those positions open for weeks, months, sometimes years. So those tiny bits of interest on a daily basis, they do add up day after day after day. And well, yeah, maybe they may care for interest rollovers. Like I said again, for us small traders, well, it's something you shouldn't really pay too much attention to. Well, I pretty much believe we are done for this video. We've covered quite a few basic terms on forex trading. It's time to get a break, both you and me. However, if you would like to dig out a little bit more of information on any of these terms that we've been reviewing on this video, there is a fantastic website. It's called Investopedia. You can find the resource link under this video. I certainly recommend it. It's some sort of an online dictionary on anything that's got to do with trading, be it stock trading, futures trading, forex trading, of course, anything that's related to trading, any term, any definition you may want to dig out. That's the place to go. Okay, Investopedia.com. You can find the link again under this video.